Hello everybody, welcome to the BizNews Finance Friday webinar. Today I've got Dawn Ridler with me, an independent financial advisor based in Johannesburg, and also Candice Paine, an independent financial advisor in Cape Town. So welcome to both of you.
Thanks, Jackie.
Thanks, Jackie.
So just for people who aren't familiar with Dawn or Candice, both Dawn and Candice are regular contributors to the BizNews thought leadership pages, and we often interview Dawn as well for our podcasts on BizNews Radio, and Candice has also worked for BizNews in the past, so some people are very familiar with Candice's work. So Candice, let's start with you. You did a very interesting article on pension funds this week, which gained a lot of traction on the website and a lot of interest. Could you just briefly sketch what your main point was in that article before we get started with the questions?
Yes, thanks, Jackie. So the point I was trying to outline is that there's been a lot of media criticism around Reg 28, the structure of Reg 28, and how people should be saving for retirement given those constraints, and how they should be thinking about where they should put their money. So broadly, the issues that people generally have is that within Regulation 28 of the Pension Fund Act, you're only allowed to invest 30% offshore. It extends to 40%, which includes 10% in Africa, but most people want developed market exposure. And so I think given the state of the South African economy and perhaps the returns that we've seen from the JSE, people are quite concerned that 70% of their investment needs to stay in South Africa. And so it really was around how do you think about that from a pension fund point of view, and what else can you do to dilute that concentration? So are there other vehicles that you can save in? And also remembering what the really good benefits are of investing in a pension fund. And the most important one is the tax benefit. Saving in a pension fund is really beneficial from a tax point of view. It saves you a lot of tax. The growth in the pension fund is tax-free for the entire period that you're saving in it. And the behavioral finance side of things, if you're an undisciplined saver, it's probably better to save in a pension fund where there are limits on how you can access that money than just have a pot of money which is there for the taking. So that was the broad kind of basis of that article.
Okay, and we saw lots of comments about it. Dawn, you're also very interested in pensions, and both of you both have a huge, you get lots of questions about how do we invest offshore. And one of the big questions this week, Dawn, has been on investing in China. What are your views on individuals taking a bit of their money and taking a bet on China?
I think you hit the nail on the head when you talked about a bit of your money. I think obviously offshore exposure, not just in your pension funds, but in your flexible investments as well, is extremely important. And then the question becomes how much of that of your investment, how much of your wealth should you put overseas? And there are questions about, you know, what are the objectives of that? I mean, is it just the rand hedging? Are you going to emigrate? Are your kids going over there? You know, different people have different objectives for, you know, investing offshore. And China is obviously a huge part of the new economy and a growing part of the new economy, and you know, has to factor into offshore. The big question is going to be by how much. An ETF is obviously you know, it's an easy way to do that. Investing in China, you know, trying to buy shares in China and that kind of thing is a high, you know, a skill set that not many, even, yeah, I should think American asset managers, that kind of thing, actually have the skill set to do that. It is incredibly difficult to invest in China. They don't follow the sort of norms that we follow in the West in terms of transparency. There's a lot of government interference. They can, you know, turn on a dime, switch things on, switch things off. So my concern would be, yeah, put some there, but really not put a hell of a lot. And I know there's been a lot of news around this IPO, the Satrix IPO in China that is open at the moment. And that is really appealing to everybody's FOMO. You know, trying to, quite frankly, put a bit of hype in there. Obviously, with an IPO, you can win a bit more, lose a bit more, you know. But for the average investor who isn't really into risk, especially at this point in time. I mean, there's so much risk out there. There's currency risk, there's the trade wars that are still going on. You know, China's now gone back into quarantine. I mean, it's just so uncertain that, you know, to add another layer of uncertainty with an IPO, I don't know.
Well, the flip side is that China has a very high growth rate, which appeals to some people compared to other jurisdictions. Candice, what is your view on putting a bit of money into China right now? You've obviously got some experience specifically with Satrix as well.
I think so. Dawn makes a good point that you are wanting to diversify. So you wouldn't put all your offshore money into China. There's some benefits to China. It's the fastest growing economy in the world. It has the largest population. It's probably going to surpass the US in terms of size in the next 2 years. As a contributor to global GDP, it far exceeds the US. And we're starting to see some of the industries there really leapfrog what has happened in the US, tech being one of them, biotech being another one. So it's a trade-off, like with any investment. Dawn made the point that there are some legal irregularities. They don't adhere to GAAP in the same way that the West does. But it is a way, so using the ETF is a way for you to access China in quite a disciplined manner. So that ETF particularly tracks the China MSCI index. So the MSCI is the Morgan Stanley Capital Index, and they've done a lot of work on what goes into that index, the market cap of the shares that are in it. So I think that it's interesting. It is an emerging market. We need to remember that. And we live in an emerging market. So when you're looking at your global exposure, you need to decide how much you have in emerging markets, how much more you want to add to an emerging market. But I think over time, as China opens up, it becomes more regulated. It wants the West to invest. It has a very small amount of Western money investing in its stock exchanges. It's going to be interesting. Like with any investment, it needs to be long-term, and you don't want to bet the farm on it. So I think I would back Dawn on what she's saying.
Thank you. So this question is from Lawrence, and he says he's looking to move his mother, who's 65 years old, overseas to Ireland, and was looking for some advice on what would be the best potential offshore options to invest her funds into. Are tax-free havens something that should be looked into? And would it make sense to cash in her pension and to pay a large amount of tax and send it overseas as a lump sum, or are there better options? So quite a few questions in one there. Maybe we should start with the best offshore options to invest her funds into. Dawn, what do you think?
You know, I would say you've got to be really cognizant of fees, and so really you would need to find an asset manager who is probably based in the UK in order to do that. But then, of course, you've got the additional problem of what, you know, how are you going to get the funds over there? Are you going to do the sort of monthly annuities going across and things like that? And then, you know, the question is that, you know, she's moving over to Ireland. Is she going to be on the Irish Social Security? And so, you know, because we got a very weak rand, you know, is there enough money there to be conservatively invested, or, you know, so to produce enough of an income once you've translated it from rands into pounds or euros or whatever else it is? So you know, because things are so volatile right now, particularly in the stock markets and that, and based on her age, I would be reluctant to advise anything that is too risky. As you know, she's not got more income coming in. If this income takes a knock, she's going to be in a lot of trouble. So, you know, I think it needs to be moved there. But of course, you know, the conservative, you know, the fixed income that's coming out of Ireland or coming out of the UK and that kind of thing is abysmal. It's almost zero. So it's, you know, you have to really do the sums really quite carefully, and then make sure that whatever it's invested in, it's, you know, low fees that aren't eroding already what's going to be sort of a low return.
Thank you. Candice, what kind of funds do you think that Lawrence's mother should put her money into?
You know, it's difficult to give advice when you don't know the facts or the quantum of the pension fund that we're talking about. You know, he's saying his mom is 65, so I'm presuming she's retired and she's already in some sort of annuity paying vehicle. So she would have the option of potentially keeping the money here in rand, hedging it, and looking at the yields that we have, because they are infinitely better than what you would get in Ireland. But then there are the costs, as Dawn mentioned, of taking the money across on a monthly or quarterly or whatever the period is that it would need to be moved across. But it's quite a tricky thing when someone immigrates and they've got one foot in both places, because then you have all the kind of idiosyncrasies of being a South African investor with living in a hard currency country. And so that's where the devil is in the detail, really looking down into it.
Thank you, Candice. And what about tax-free havens? Where do you start with tax-free havens? There's so many of them, and some are low tax, no tax. How do you sort of structure your affairs in that way, would you say? Dawn, do you do much of that work with your clients?
Yeah, we do. You have to be a LANIO with long bucks. You have to be pretty wealthy to use that as an option, because it's not for free. You may pay less tax, but they're going to get you somewhere else. So I mean, if we're talking lots of money, if we're talking millions of euro, then by all means, there are lots of those tax vehicles that you can use all over the world. And the thing is to look into all of them very closely, and specifically to look into how those funds are locked in, because quite a lot of these investments that are in these sort of tax-free havens and that they lock you in, and you really can't get out for a long period of time. And then some of the costs can be absolutely prohibitive. They may require you, for example, to put it in a trust, and a trust costs £1,000 or so, a year. And you can soon, eat up any kind of advantage you might have had by putting it into a tax-free situation. I think when you do making a move like this, and if it is a large enough sum of money where tax is going to become a real issue, then you can start looking at, say, the Isle of Man or Jersey, or something along those lines, to do it.
So if you aren't a LANIO, what can you do with your money to minimize those tax liabilities, Candice?
Not much, actually. For the man in the street, the individual, we need to, pay our tax. There obviously, Ireland has the tax-free saving accounts like we do. They would have beneficial tax rates for pensioners. But for most of us, we have to pay our tax. And if you structure it properly, South Africans love the term loophole. There aren't many loopholes left. Most of that's being closed. We need to pay our taxes. But if you structure your investments properly, draw them down in an orderly fashion, you can usually minimize the tax that you pay. You can take advantage of the things that are there for you. But I would say for this gentleman, for his mum, that once he gets to Ireland, that he actually does consult with somebody over there. It's very difficult for us to sit in Cape Town and give advice on tax in these different jurisdictions.
Thank you. Yeah, sorry, continue.
Sorry, and just to add to Dawn's point, about the trusts and the various structures that they have for kind of the super wealthy. What people also don't realize is once you put your money in a trust, you kind of lose control over it. Legally, it's no longer yours. It belongs to the trust, and you need to start making requests to get your money out. Some of these trusts are also wrapped up in pension funds. So you may take discretionary money and now subject it to pension fund rules. So you really do need to take professional advice when you're looking at taking large sums of money offshore. Otherwise, for the man in the street, the tax that you're going to pay is the tax that you're going to pay.
Thank you. Now, here's a question from Clive. He says, in view of the restrictions concerning Regulation 28, would you transfer your paid-up RA to an LA? Dawn, would you like to briefly answer that question?
I've actually had this request a number of times and did this discussion over the last couple of months with clients. And in some cases, the answer is absolutely yes, because it does, once it's in an LA, because it's not governed by the pension fund rules, you can, take much more, and up to even 100% in offshore investments if that is what the client wants. And it can make sense. It really can make sense. Obviously you need to do the sort of the maths on it, and it might be questionable if the client doesn't need the money, because obviously at least 2.5% of that is going to become an income. But there are ways obviously around that, and I mean, because there's nothing stopping you to continue to take do another RA and still take tax benefit on it. But I have actually recommended on a couple of occasions that that's exactly what my client does if they're over the age of 55 and not stuck in and the money not stuck in an insurer who says your retirement age is 65 and we're going to penalize you if you take it up or retire from it.
Thank you.
Which happens all the time.
So this one for you, Candice. Helena asks, as someone who's been hanging on to an investment in a value fund and waiting for it to perform, what are your feelings on the future performance of value funds? And if government defaults on payment of debt, what effect will it have on the rand and on investment? So quite a broad question.
Okay, there's two questions in there. Let's start with the value option first. So it's been a terrible time for value investors over the last, I would say, 5 to 10 years. Just for the people on the line, what a value asset manager does is they look for beaten down stocks and ones that the price has fallen, and they buy into it and they wait for that stock price to rise or the value to unlock. The market that we've been in for a long time has been a growth market, which means that shares that have recently done well seem to continue to do well. Companies with high growth in earnings. And those particularly have been the tech stocks, which we've seen lately, which has meant that more and more money chases those growth stocks and less money chases the value stocks. The value stocks don't mean that those companies have no value. It just means that for some reason there's no price movement at the moment. The kind of pundits in the media are always saying we're just on the precipice of the move from growth to value, and they've done it in this time of COVID as well, and we haven't seen it yet. The thing with investing in the stock market is that the returns come through like a train. They don't come through linearly. They don't compound every day like it does in a fixed interest portfolio. So if you back the portfolio manager, you back the house, the philosophy, the process, and in the past you have seen that process working, I would not move out of your value investments now. Because Murphy's Law, the minute you move out of the value investments, the price starts to rise. And there are many instances where you can look at the days that you needed to have been in the stock market for you to have gained the performance. And it's probably 5 days, but you've sat there for 5 years. You miss those 5 days, you miss the return. So that's my long answer to a short question. Sorry, Jackie, can you repeat the second half of the question?
Yes. So what happens if the government defaults on its debt? There's this concern that was raised by Finance Minister Tito Mboweni when he announced his special budget. He was talking about how South Africa was hopefully going to escape a sovereign debt crisis. So there's this concern by Helena that what will happen to her investments if, in fact, South Africa does start going down that route. Or do we have, maybe we don't have to worry about that now, or how do we mitigate against that?
Well, we do, it's there. South Africa is needing a large amount of cash, and we've all been watching Tito and his budget, and he's been mentioning, the risk of a sovereign debt crisis. I think he's working very hard to mitigate it. But if the government does default on its debt, we're going to have bigger problems than, unfortunately, our individual investments, where we will see the values fall, but we'll also see the yields rise, as we did when we were downgraded by Moody's to junk status. So I think the way to mitigate against all of these things is diversification, and looking at what is in your portfolio, looking deep down into what is in your portfolio. So if your fear is a sovereign debt crisis, don't only hold government debt, or hold short-dated instruments in the fixed interest portion of your portfolio. And that's where you really do need to rely on the professionalism and the knowledge of the asset managers that are running your portfolio. But yes, these are all issues that everyone is thinking about at the moment and worrying about it, rightly so.
Dawn, what is your feedback there? How do you think somebody can mitigate against these risks apart from going offshore?
Well, you know, bonds have been a huge part of most of my clients' portfolios for the last 2.5 years, but that's been corporate bonds. And even the big investment houses out there have said we're not going to touch government debt. They're concerned about it. So that if you're invested in sort of unit trust and it's got a bond component, the chances are that you haven't actually got that exposure. But the problem is that although you may not have that sort of direct impact, it may not directly affect your investment in terms of losing value on the bonds, or the bonds not defaulting, in that it's the ripple effects it's going to have over the whole economy, over the interest rates, over the risk and everything else. So what would probably happen is that something like the R186, if we were to default, we would be seen as extremely risky, and the yield on that would go through the roof. So there could be a silver lining in it for people who have enough stomach to actually sort of take that risk and say, listen, this is going to come right. This is just a temporary situation. Because back in our history, we have had to go to the IMF to get bailed out, which is basically what we're talking about here. So it's not going to be the first time, and we've come through it. It takes a bit of time to come through it, but it will impact on sentiment. We'll be seen as a banana republic, and it will impact on our stock market, on our economy, on business sentiment, on consumer spending, on it's all those other sort of ripples that would come out of it that would probably have a greater impact than the direct impact of actually holding government debt in your investments.
Thank you. And then we've got somebody who has a caveat. It says that if you put your money into an LA, you can't get it out again. Do you just want to respond to that caveat, please, Candice?
Yes, that is correct. So once you own a living annuity, the way that you draw it down is you can choose between 2.5% and 17.5% of the capital per annum. So when they say you can't get it out, you can't make lump sum withdrawals or 100% withdrawals. So these are all the things that you need to weigh up when you're deciding how to manage your pension going forward, which is also one of the things that I mentioned in the article, is that you maybe want to be investing, taking advantage of your tax-free saving account and other flexible savings so that you've got more liquidity as you go into old age. The other thing with the living annuity is that if you immigrate, and many people are thinking about this, your living annuity is stuck here. And so then you are going to be drawing it down in South African rands and taking that money offshore. Whereas pre-retirement funding, you can pay the onerous tax on the lump sums and take the money when you go. So yes, that's an important point. So well made.
Thank you. And then a lot of the questions that are coming through today are connected to offshore investments and what is going to happen in the US from a political perspective in November. And a number of people are asking questions that are along the lines of this. We've been investing in US dollars and it has treated us very well, but to take money offshore at current levels, and the US dollar is very uncertain with presidential elections coming up. What are your views? What do you think, Dawn?
Yeah, I agree. I think we've been, I certainly have been watching very carefully to what Joe Biden is talking in terms of starting to put his policies together, because he's been big on, I'm the alternative to Donald Trump rather than I've got better policies. And so, that's what we need to see. So I think, the Fed is going to do everything it can to prop up the dollar and the economy. That if they have to throw another $1 trillion at the problem and make it their grandchildren's problem, I think that's exactly what they'll do. They'll do helicopter money. Up to 70% of US GDP actually comes from consumer expenditure. So helicopter money, which is when you put money directly in the hands of the consumer, which is what they've been doing, I think has worked very well. It has spawned a whole lot of other problems. But I think the Fed is going to do everything it can. You know, they can't use interest rates at the moment, and that's what their forte is supposed to be. So they're now actually starting to get into economic policies that are really not traditionally found in the Fed. But I think up until elections, unless something really drastic happens, you're going to sort of see a muddling through of this, and unless there's a dramatic effect. I think most of us who live in these countries are, you know, like Africa, that Trump doesn't think very highly of, you know, look forward to the day that you know, he you know, moves out of the White House. But
Right.
you know, that, you know, might not happen, and so there's going to be a lot of uncertainty in that. I think Biden will be as good for the economy as Trump is, but you know, in a different way.
Thank you.
He'll probably
Candice,
be,
sorry, you often
yeah,
see presidents serving 2 terms in the United States. So perhaps there's an expectation that we could see the current incumbent in for another period. In that case, how would you be looking at your US investments?
If Trump gets a second term.
Yes.
Well, there's been no sitting president who's been voted in for a second term in a recession, so I'm kind of holding on to that. But as Dawn said, Trump has been really good for markets. You know, he's Make America Great, and his isolationist policies have seen stock prices surge. And I think, you know, that if he comes in for a second term, he'll keep doing that. But what we'll see is the escalation in global geopolitics, you know, and his current spat with Xi Jinping. Regardless of who's right and wrong, you know, they both have issues on both sides, is going to be interesting for businesses going forward. So we've already seen, just on the back of COVID and countries looking at supply chains, that they're trying to become more localized. So it feels like the global village will start shrinking and people will kind of revert back to their natural states. So I think that if Trump goes in, the markets will continue to do well. But I think longer term, the world is going to be a very different place, and how people do business and what that means for the flow of capital will be a very different place. But I think that the dollar is going to remain the reserve currency in the world for the foreseeable future. And to kind of come back to answering questions, you know, people are always nervous about where and how they should invest their money. It's a long-term view. I keep saying this, but it really is. You know, we're not putting our money into the dollar for the next 6 months or till the US election. You're putting it into the dollar for a very strategic reason, because you live in an emerging market, because you think the rand is, you know, going to depreciate eternally, because you want access to the types of markets, the types of technology, the types of companies that we just don't have here. And you're looking for actually slow compounded growth. You're not looking for the kind of growth that we've seen right now. You can also see the fear reflected in the gold price currently. That's shot, you know, the gold price has shot through the roof. It went through $1,800 yesterday. And you can see it in the gold mining stocks around the world. And that's a fear indicator. So people are nervous. They don't know what to do. Depending on which side of the fence you sit with gold, whether you think there's value, whether you don't think there's any value, you can see that people are nervous and they don't know what to do. And it's times like that that you really need to know your fund manager, trust your financial advisor that they're putting your money where it needs to be, and that you have a very long-term plan.
Thank you. Now there's another question here, which is a follow-up from the earlier one, where you mentioned that it's very tax efficient to invest your money into a pension. This webinar attendee wants to know, should he continue contributing the maximum towards his pension, or should he rather pay more tax and start investing offshore? What do you think, Dawn?
You know, it depends where you know, if we're talking about a retirement annuity, or are we talking about a company pension fund? I always recommend to my clients is that they do the amount that is required by their pension fund into their pension fund. And if that hasn't reached their maximum and they still want retirement savings and to take advantage from a tax perspective, then to start an RA on a list platform, because, you know, they have more control over that. and today not necessarily any more expensive. So I mean, there's that aspect to it, and also by putting it into your own RA as opposed to the company RA, you are going to be able to maximize what is available in terms of offshore exposure within that RA that you may not be able to do on the company side of it. You may not have the full spectrum of choice. So, but once you've maxed out on your 27.5% that you can claim back from tax, it doesn't obviously make sense to put any more in it. And I think when it comes, there needs to be a number of buckets of investments. I mean, it shouldn't all be retirement. It shouldn't all be, you need to have your emergency fund. You need to have your flexible investments. You need to have your pension things, and you need to actually sort of roll all those boulders up the hill at the same time, rather than say, okay, I'm going to make sure that this one's full, and then I'm going to try the other two. You have to start thinking about different buckets of investment, and the more of them that are under your control, the better.
Thank you, Dawn. Candice, here's a question from Yaku, who wants to know, what are your thoughts on the new blended type of retirement annuity with managers such as Alan Gray? And they mention a with profit annuity. Are you familiar with that product?
Yes, I am. So, as people retire and they don't have, they haven't saved enough for retirement, briefly what they do is they keep a portion of the money in a living annuity. So a living annuity where you are able to choose where you invest the money. So where you have all the choice, you also have all the risk. So you're now making a choice about where you invest, where if you have a guaranteed annuity, it basically pays you out a guaranteed amount for a period of time, depending on what you choose. And the blended ones give you a portion of each of those annuities within your annuity. So, it's so difficult because Dawn and I both keep saying it depends, but it really does depend on the situation. So if you're unfortunate and have not saved enough for retirement, those kind of blended annuities really do serve a purpose, because you've got a portion of it guaranteeing and the other portion is in the market where you kind of still have the opportunity for outperformance going forward.
Thank you. Dawn, do you ever recommend this kind of product to your clients?
No. And even, the sort of the guaranteed annuity, look, there's been a time in the recent past where you could actually get a really good return, when you were getting sort of 8.5%, 9.5% or whatever it is on a compulsory annuity that was a life annuity rather than, but there are very few people out there who can actually sort of come to grips with the fact that, one, you have absolutely no control over it, and two, unless you obviously take a much lower amount, it dies with you. And it's and I just have some real problems with it, and most of that is because you're giving up the control, and you need to look and say, right, can I mimic this? If the drawdown, you're drawing down, say 4.5%, 5%, you don't have to have an economy that's shooting the lights out to be able to have that capital, grow the annuity, and for it to last the rest of your life and still pay out to your beneficiaries at some stage. Whereas with something like this, where you're getting the same amount of money, but you die in 2 years' time and your $5 million is cheers, babe.
Thank you. Candice, here's another question from Francis. How does a completely new first-time investor start to invest offshore? What are the very first steps they should take? Maybe at the first investment, is there a way, for example, of investing in Warren Buffett's suggestion of putting money into the S&P 500 as a good bet?
So there are a couple of ways of investing offshore if you are a South African investor. We obviously have exchange controls, so we're limited to what we can take physically offshore. Broadly, that's R1 million each year, which is your travel allowance. And then if you're lucky to have a further 10 million rand, you can apply for tax clearance and take that offshore. So the two options you have basically are investing in South Africa in rand-denominated offshore funds, or taking your money physically offshore and then investing it in any jurisdiction and any security that you want. The difference between the two of those obviously comes down to costs and accessibility. If you're a first-time investor and you really are a DIY investor and you're wanting to get a feel for it, I would go for your rand-denominated offshore ETFs, which is something that Warren Buffett would offer. So your S&P 500, your MSCI Worlds, there's an emerging market one, there's the NASDAQ 100, there's a load of them. There's a basket of rand-denominated offshore ETFs that you can access locally through your stockbroker. One of the list platforms now has some of them available. There's a very easy site I can mention, Easy Equities. You can go on and access these with low or no minimums. Once you start getting a little bit more sophisticated and you have large lump sums that you actually physically want to remove from South Africa because perhaps the political risk is too much for you or you are immigrating at some point, it becomes a different ballgame. And then we're looking at some of the structures that Dawn mentioned earlier. And then the world's your oyster. Then you have all the active managers, a whole plethora of ETFs out there, single stocks, and then you probably want to either start doing your homework or finding an advisor to help you. But those, I would start with the local rand-denominated offshore ETFs.
Thank you. Now, here's a question from Carl. Lots of talk about long-term investing, he says, but keep in mind elderly pensioners might not have a long-term to work with. So in other words, it's all very well thinking of the long term, but have you got any suggestions for people on how they can boost their returns in the shorter term, given that we're all struggling for money now?
Yeah, the short answer is, there are no shortcuts without incurring significant risk. And when you're old and you no longer have the opportunity of more income to, fill up the pot because you've made a mistake or the markets have gone against you, you just can't do it responsibly. And, if all of us would love, if you've got a client that's 70 and they haven't got enough money, you've got very few choices to do something. The question has to be around not getting more, it's actually spending less at the end of the it's a difficult question. It's a difficult conversation to have with any client, is to say, look, sorry mate, you didn't put enough away, the markets aren't cooperating, there is no get rich quick here without, then you might as well go to Monte Casino and put it all on black. That's how much risk that you would have to, expose a client to. You've got to be responsible as an advisor when you have that, and you have to, understand the behavior, the financial behavior that comes with that kind of question. Is that, I haven't put enough away, and I need more. So, you have to be almost like a sort of finance coach in many respects when you're a financial advisor, because you have to ask questions that they don't want to hear, and sometimes they'll fire you for it, but that's it.
And your views, Candice? How do we get a quick return here?
You don't get a quick return, what Dawn said. One of the other things that you can, so I think the focus is on spending less. Sometimes that's an impossibility. Some people are down to the wire. Then it's looking for, can I rent out a room? Do I have things to sell? But there's no solution. I was having this discussion with a friend yesterday, and investing's a bit like dieting. We all know what to do, but now it's your wedding day. You can't start on your wedding day. So it's, you've got a plan. You've got a plan. You've got a plan.
Okay, thank you. We're coming to the end of the webinar, and we've got a couple of questions on cryptocurrencies. Now, first of all, one says, have you ever heard about the new cryptocurrency PI or Pi, and do you think it will succeed? What's your general view on cryptocurrencies, Dawn? Have you dabbled in crypto at all, or taken it seriously, or looked at it?
Yeah, I think it's a great gambling tool. Good fun. It goes up and down like a yo-yo. Great. As an investment strategy, no. You know, you go play. You know, obviously blockchain technology has got enormous implications and really good implications, and cryptocurrency is one of them. It's still far too early days for serious investors, and unless you've got a hell of a lot of throwaway money, money that you could either go to Monte Casino or put it on Bitcoin. Go put it on Bitcoin or whatever. If you lose it, you lose it. If you don't, you don't. Look at it as your entertainment money.
Thank you, Dawn. Candice, you feel the same about cryptocurrencies?
I do. The only thing I'd like to add, and maybe people can think about this a bit, is that everything that you invest in, you're looking at the intrinsic value, because you're wanting it to sell the thing to somebody because they see value in it. The problem with cryptos is that there's no intrinsic value at the moment. So what are you investing in? So I would say, if you're scared of gold, where people kind of question the intrinsic value of gold, then stay away from cryptos. Not as an investment, as fun, yes.
Thank you. And then one last question: if you want to make money by investing in the health crisis and the cure, is there any way you can get into some kind of investment? So there's talk about ETFs that invest in healthcare companies or the vaccine. Is there any way you can access what will obviously be a boom industry when the COVID-19 vaccine is discovered? Dawn?
There are hundreds of companies out there, probably even thousands, that are looking for cures and for vaccines and all of that kind of thing. So, some of them are going to have better results than others. I mean, you could, throw some money at it. But I think one of the things that people don't consider is that governments could very well step in and prevent price gouging. So these companies are not going to be able to, charge what they like. Even with a cure, the pharmaceutical companies are not going to be able to charge what they like if it's seen as usurious, if it's seen as gouging, the poor and that kind of thing. So yes, I think money can be made, but I don't think there's the sky's the limit. I mean, even with remdesivir, the price of remdesivir is prohibitively high especially for emerging countries and that kind of thing. And there's already moves to say, right, almost nationalize some of these things, or sort of bring pressure to bear by way of sort of fines and that kind of thing to try and keep the costs of some of these under control. So it's too regulated, I think, for people to really make a killing.
Candice, are there any ETFs that you can think of that might give people some exposure to this boom in medicine that we might expect in a few months' time or in a year's time?
So they're not listed on the South African Stock Exchange. There are biotech and pharmaceutical ETFs that are listed globally, and that would be one way of at least kind of, covering the net if a vaccine should happen, but also because people are looking at public health, and it's becoming more and more important. And the longer that the coronavirus lasts, the longer these things will. So that's one way of maybe participating in the upside. But the other thing is you may have missed the boat already. If you look at the prices of these things, they've shot out already. So yeah, be careful.
Okay. Thank you. Well, thank you very much to Candice Paine and Dawn Ridler, two independent financial advisors. Candice is in Cape Town, Dawn is in Johannesburg, and thank you to everybody who attended the webinar today. If you have any questions for us or feedback or suggestions, please do send them to the email that you can send. So thank you very much for joining us today, and have a good weekend.
Thank you.
Bye, Jackie.